It told me. Hey, Adam, we're live.
Hi, Paul. I'm not going to itch my eye this time. Yesterday's post looked a little funny. How's it going?
Hey, pretty good.
Thanks for joining us. Thanks for being here, Paul. I appreciate your time.
Yeah, same to you. I'm really glad you carved out a few minutes of your day
to Thank
hop hop on the internet, and we can have a chance to do some rambling. So that's pretty
Sounds
good.
Great.
So Adam, if it's Friday, what does that mean?
It's Friday. It's time for us to share a little bit of knowledge, and hopefully folks learn a little. Quarantine edition.
Yep. I don't know what week we're on. We should pay attention.
Although I guess slowly these are transitioning out of the edition of quarantine.
Yeah, that's right. I mean, we could do this at the office.
Yeah, that's the word on the street.
I think I'm more productive here, though.
I actually like staying home. Don't go to work.
Yeah, big fan. So we have our friend Kathy already waving. Check it out. Bam, there she is. Boom, bam. TGIF. Oh, right next to her.
Hi, Kathy.
Over. We got Greg. So we got the whole crew out. Whole crew's out. All right, Adam. What are we going to talk about today?
Today we're going to talk a little bit about seller finance purchases. Seller financing on which can be applied to both real estate and also to other things like businesses.
Yeah, we help clients often on business transactions where someone has owned a business for a long or short time. It's what we did. We owned a pizza shop. Remember that, Adam? When we owned a pizza shop, we sold that to an employee with seller financing. So it's an interesting thing that not many people do unless they see, they get the opportunity and a seller is willing to go that route. So, and we'll talk about it. Let's talk about both, Adam. Let's talk about business seller financing. How did that work when we sold our pizza shop?
So the one way to think about it, seller financing obviously describes the scenario that the seller is the person financing it, which means there's not a seller, buyer, and a bank financing it. The seller fills both roles. And so the way they do that usually just set up a payment plan on and then eventually transfer the business to the buyer once they pay off whatever that plan might be. So usually you get a down payment. You have some terms about how the buyer is going to take over the business, and then forecast the payments and the eventual transfer of any assets or anything else you might need for it. Depending on the business structure, there may eventually need to be membership interests transferred or things like that. Right. So that's the general idea there for a business. And again, the seller is the person that's going to be collecting the payments rather than getting financing from a bank, and the bank gets payments. It's just the former owner. It's going to be getting those payments and potentially earning interest on the sales price. So it can be a nice way for the business owner to be continuing to make money off the business they previously owned without having the day-to-day operations.
We got Brad saying hi with lips. There's a little suspense there at the end.
He's about to reveal something.
To tell me something else. Yeah. So the nice thing about business seller financing is that the prior owner can continue to get some cash flow on that business if it's something they were actually getting when they own the business. So it's another good reason for that. And the difference between seller financing on real estate and in a business is you may be wondering, but how am I protected if I transfer a lot of stuff over to my employee or somebody else that's going to take over when I sell it to them? You do a UCC filing against the equipment. So that's kind of you can obviously collateralize other stuff. You can say, hey, give me some sort of deed to your car, or, let me lien at your real estate if they own. But that's the seller financing of a business. To protect yourself, you can do UCC filings. You can lien other stuff like a house or take title to something, by separate agreement. So,
and then I'll add in the real estate element of it is the business might be just leasing. So you just would work with a landlord and assume that lease. It would be assigned to the buyer if there's not real estate owned by that business. Sometimes there isn't. So it's a hybrid business and real estate sale. but in a lot of cases, it's just going to be assigning a lease contract. All
Very
right,
good.
so we did the hybrid approach, Paul. Now you can talk about strictly a real estate seller financing.
Sure. So if you are interested in purchasing someone's property, but it's either not financeable traditionally through, going to a bank and asking them for some, because either maybe it's underwater, so you wouldn't be able to actually pay off the first lien, or if the seller is looking to continue to have some ownership, or just want some cash flow from the real estate, you can do a couple things. One is called a money mortgage, which is essentially just the seller acting like a bank, transferring title, but then just mortgaging the property and putting a lien against it to protect the payment. The other is a land installment contract. So in Ohio and many other states, it's essentially like a bank transaction, like the ones you maybe have been a part of, or you know of, but the title doesn't transfer from the seller to the buyer. That doesn't happen until some date down the road. And then there's some differences as far as protecting payment, how you can get your payment back. And can you tell the difference between trying to collect some of that money? Let's say you sell or finance a property to somebody, but they don't pay it. What's the difference between a mortgage, typical money mortgage, and a land installment contract?
Yeah, so the standard mortgage and note, which is kind of similar to a regular transaction, is just no bank involved. It's the seller that's the bank carrying a note and mortgage after they transfer the property. Then that's going to be a traditional foreclosure case. In a traditional purchase sale transfer at time, you get the purchase sale agreement, and then they do a note and mortgage. That mortgage, if the buyer defaults, the buyer defaults, then you need to do a foreclosure at any point. On a land installment contract where you're not transferring title, but you're going through the seller financing, and the person's supposed to be making payments under the land installment contract. If there's a breach there, then there are some requirements on giving notice and giving them a chance to cure, especially on residential. But the important term thing for people to know about is the 20% rule, which says that if they've paid off at least 20% of the purchase price, it changes from what's called a forfeiture to the foreclosure. So anything after 20% is the same as a regular mortgage foreclosure that most people are familiar with. Prior to 20%, it's a forfeiture, which is similar to an eviction. So it doesn't require as much in terms of a court proceeding, and you don't sell it at sheriff sale. You just go through essentially an eviction process. And that 20% distinguishes those things.
Right, so it's treated almost like an eviction. So if you were to seller finance by a land installment contract to, like if I seller finance to Adam, my house, and he only made payments for a little while, in order for me to cancel that contract, I go to, and there's a different timeline with a forfeiture proceeding than an eviction as far as days and rights secure and stuff like that. But if you go, you would file in the same court as an eviction, and then you would have a court order that contract is actually canceled. So similar in ending a land contract under 20% of the purchase price as an eviction, but it's and it's obviously a lot faster than a foreclosure. In Ohio, foreclosures can take anywhere from probably 6 to 18 months, depending on the debtor and their representation and how they're dealing with the litigation. So
yeah, and then from a buyer borrower perspective, it's a good thing that they put this law in place for a reason. If you're a buyer, you make at least 20% payment on the thing. They don't want you losing everything, losing all those payments. So they require that the lender seller go to foreclosure, which might allow, if it gets enough money at foreclosure sale, the borrower might actually get some of that extra equity that they had put into it. So it's a way of protecting buyers too. So yeah, and if you are a person on that side of seller financing, it's important to know that that's the case too.
Great. So we have clients now taking advantage of seller financing on the commercial side of things. There are new opportunities since right now the at least for some, I mean, we have a number of people we're helping where it hasn't affected their business as much as maybe one have expected, 6 weeks ago. But there are owners of apartment complexes who aren't, who maybe weren't as prepared for this, for a big loss of tenants. So buyers are now reaching out to sellers and suggesting seller financing, and we've actually seen that doing pretty well. So it's something you should get your arms around. If you have questions about how it works, obviously you can. One, you should join us live here on Facebook by clicking that goofy link I put in the timeline. And maybe this guy has a question about seller financing. Any questions about seller financing? We got clients coming off the street, just coming right to the office.
No Who let him in here?
So it appears the secretary let him right in. So he's got no questions. That's good. Is there anything else that we've missed? Is there anything we've missed talking about here?
No, I think it's pretty good, and it's been in a Quoran 11 and a half. So
yeah, we've
pretty good.
We've bothered people less than we usually do, and nobody's asking any questions. We did get a couple good waves from
the holiday weekend started.
That's right.
Way to do it.
I think we should join them. So that's it. Hope you learned a little.
Yep. Thanks for joining us, everybody. Wave.
Thanks for joining us, Client Reed, and yeah, we'll talk to you later, man.
Thanks, guys.